Hello, and welcome to this breakout session entitled ECA Financing and Private Sector Risk Mitigators at the Ex-Im Bank Annual Conference for 2021. My name is David Fiore, and I am the Vice President of the Transportation Division here at Ex-Im Bank. I will be the moderator for this discussion. Today, we will discuss various aspects of export credit agency financing and private sector risk mitigation. I'm very happy to have with me today two distinguished panelists. Our first panelist is Mr. Joe Monahan. Joe is the Chief Executive Officer for Aon's Public Sector Partnership. The Public Sector Partnership focuses on developing innovative solutions to help governments and other public financial institutions reduce volatility and increase the resiliency of their mission. Prior to his role leading the Public Sector Partnership, Joe was the strategic growth leader for Aon's U.S. reinsurance platform. Joe was also the founder of the Credit and Guarantee in Government practice, which led the development of reinsurance solutions for Fannie Mae and Freddie Mac to reduce their exposure in future housing downturns. Joe was also developed the reinsurance program for FEMA and the National Flood Insurance Program to reduce exposure to catastrophic floods. Joe has also worked with Ex-Im Bank in our pilot reinsurance program that we launched several years ago to reduce exposure in export finance volatility. Joe has been with Aon since 1998, working on the actuarial and financial modeling side of Aon before moving over to the brokerage division. Joe is a graduate of the University of Chicago. Our second panelist is Jeff Abramson. Jeff is head of the specialty risk group within the global political, credit, and bond team at AXA XL. Between 2013 and 2018, Jeff established and led AXA XL's short-term trade receivables insurance business. Jeff has more than 25 years of experience in both the public and the private sectors, including positions here at Ex-Im Bank, where he served as acting senior vice president and head of export finance, as well as the head of the trade finance division for many years. Jeff was an active duty military officer and is a combat veteran. He is a graduate of the United States Military Academy at West Point and earned several master's degrees, including one in national security studies from Georgetown and a second master's degree in finance from George Washington University. I'm very happy that both Jeff and Joe can join us today. So, gentlemen, I thought perhaps you could start us off by providing an overview of private sector insurance and the private sector insurance market, for example, how it works, what types of assets and risks can typically be insured, and what some of the limitations of private insurance might be.
Sure, happy to. And David, thank you so much for giving us the opportunity to join you today. The insurance market is a very, very large part of the global economy, and it functions best when it's frankly something that people don't really think about until they need it. When you think about insurance, most people think about their personal insurance and their homes and automobiles, and of course that's a very, very large part of the insurance industry, but commercial insurance is a massive part of the industry as well. And that helps businesses with all kinds of risk, and it facilitates trade, not only between individuals and businesses to businesses, but internationally. It has its roots going back literally hundreds of years. In fact, the first insurance contract, I recently took a look at this, the first insurance contract that we can track goes back to the 1300s. And it was a trade mission to the Middle East. And there was an insurance and reinsurance contract on certain channels of shipping because there was a lot of pirate activity. So it's got a long history in international trade. The thing that I think is really terrific about insurance is its nature allows for a lot of customization. And that means that it has evolved over time to meet new needs. And that at this time is something that we are keenly excited about as the economy changes, as risk changes, as we are ever aware of long tail events, black swans and the like that we've just are living through now. So I think there's tremendous opportunities for the growth of the product as well.
Yeah, and then David, also like to add my thanks for being invited. Appreciate you thinking of me for this panel. As you mentioned, I spent 11 very productive and happy years at Exim, and glad to see the institution, which I still have great fondness for, continues to perform its mission. To the question of sort of what does the private insurance market bring, I think picking up on Joe's comments, it brings a lot of kind of granularity across our whole space of export and trade finance. We I think about things broadly speaking the same way that the bank does and other ECAs in terms of looking at the political risk insurance piece, vice the export credit sort of non-payment side. And within both of those arenas, the private market really spans the gamut. On the PRI side, all the standard coverage, currency and convertibility, expropriation risk, physical damage, that type of thing. And then on the non-payment side, you can find short-term, trade receivable coverage, like the business I started here at XXL, everything to 20-year now project finance deals. So there really is a lot of flexibility in the private market, sort of across the universe of the arenas that I know the bank participates in.
Well, Jeff, given your experience at Exim Bank that you mentioned, I would be interested to know, are there any differences that you've noticed in terms of the approach or the appetite, or from the perspective of a government export credit agency and a private insurer? Are there risks that you won't even touch or won't look at, or that kind of thing?
Yeah, there was definitely a very substantial culture shock for me leaving the ECA world to the private insurance market, which in a way sort of surprised me because fundamentally, right, a lot of the coverages that I just described, the bank and other ECAs participate in, credit risk is sort of credit risk, right? We're looking at the same things. Analyzing a project finance transaction is analyzing a project finance transaction. But there really are some dramatic differences in a lot of ways, and maybe I think we'll come on to this later, complementary across the two different agency types, if you will. The most fundamental, I guess, for me was, just the inherently greater universe in which the private market can participate, right? We are just not at all constrained by the same kinds of things that, ECAs are constrained by in terms of content and national origin and ties to employment, creation of jobs through exports, was really, it's a very different, I have to admit, somewhat refreshing, going to the private side where, a good deal is a good deal, and it really doesn't have to satisfy any of those, again, very understandable criteria. And then, the other thing that, as I was thinking about this, sort of struck me, and, having been on both sides of this, I think I can fairly talk to it, is I think there's that old sort of saw out there that, the ECAs are so slow and deliberate and bureaucratic, and the private market is much more nimble. And to some degree, yeah, that's true, but it's true because of the nature of the roles that each participant plays. And, I was thinking about, why in some cases, are we able to respond really quickly in the private side? And it as compared to maybe when, at least my time at Exim, one of the things that occurred to me was, a lot of times we're providing very limited levels of indemnity to sort of bank partners of ours who have already underwritten, structured a deal, maybe already syndicated it to other bank partners, and are really just looking for another means of moderating their hold position. We have access to their credit underwriting. We know they have customer relationships, so we can really rely on that and make relatively quick decisions in some cases, versus certainly putting my old Exim hat back on. Someone's asking us to cover 85% of a transaction in an emerging market, which sort of by definition is too risky for the private market. Well, we'll tell you like when we're ready to make a call on that on behalf of the taxpayer. So I think there's just some real differences in kind of how deals are fundamentally approached.
So that's very interesting. I appreciate that. Joe, a similar question for you. You've worked with other government agencies. Actually, you've worked with Ex-Im Bank as well. It would be interesting to know your perspective on how other U.S. government agencies, such as FEMA or some of the other agencies you've worked with, how they manage risk with respect to trying to accomplish their missions.
Yeah, and it's a good question. Maybe, and you're right, David, it kind of builds on what Jeff was talking about. So, one of the things that Jeff highlighted, and I think it really came to the fore with the pilot transaction that was done on your aircraft portfolio, is the role that, in this example, Ex-Im played in crowding capital into areas of the marketplace. And we see this, as Jeff pointed out, quite often Ex-Im, other ECAs, and government agencies more broadly are active in areas of the economy that may have more risk associated with them, or are introducing programs, loan programs or guarantee programs where those didn't exist prior. And they play a role in sort of priming the pump, so to speak, in terms of bringing capital to those segments. The risk transfer component creates the opportunity to bring private capital into those segments where, without the presence of Ex-Im or another government agency, private capital might not go, because they would be uncomfortable taking that risk. It's either a novel risk or it's an area of the economy where maybe the incentives aren't as aligned as they might like. But the presence of the United States government via an agency actually gives them the confidence to support that opportunity. That's a really important part of these partnerships. And we do think about them as partnerships where the insurance and reinsurance industry is truly trying to understand the motivations of the agency, the mission of the agency. Of course, understand the risk, as Jeff pointed out. There has to be a prudent underwriting of the risk on the front end, prudent pricing of that risk on the front end, so that they can evaluate it on the back end. But what we see with other clients of ours, government agencies, they are very interested in how these insurance and reinsurance partnerships certainly protect the taxpayer and reduce volatility, how they create certainty around the resources that agency has to do their job. So agencies that are receiving appropriations, this creates budget certainty for those agencies, because the volatility that might come out of that program has been limited by the presence of an insurance contract. But the third component, which is we've seen that's really, really important, is, and Jeff touched on this, the agency might see one thing or one type of thing all the time, but they don't have a broader global perspective or even a perspective outside of their agency. And increasingly, we see how interconnected things are, how interconnected risk is. The private sector does have that global perspective. And so one of the most valuable things that has emerged, and it wasn't necessarily anticipated by our clients when they first entered into these risk transfer conversations, is the perspective and insight on risk that the insurance and reinsurance market brings, because they're seeing deals maybe from other ECAs, in the example of Ex-Im, and they're seeing that marketplace more globally. Or in the case of FEMA, they're seeing risk to flooding and natural disasters from all over the country, in fact, all over the world. They have an ability to quantify that risk and provide perspectives on that risk from a frequency and severity standpoint. Or in the case of Fannie and Freddie on the mortgage side, they have not only a view of kind of mortgage credit risk, but broader systemic risk that is actually useful and helpful to Fannie and Freddie as they think about the marketplace in which they operate. So that kind of multi-dimensional relationship has become really valuable overall as we build out these partnerships.
No, Joe, your point about Exim Bank being a catalyst to bring other capital to the market, I've actually seen that live in connection with some financings we did for airlines in Africa, where Exim Bank was guaranteeing the typical 85% piece, but the presence of Exim Bank attracted a guaranteed lender who was willing to, with Exim Bank support, do it, but also provide junior debt or pre-delivery payment, other types of financing. And then once that the banking community got more comfortable with that particular risk of that particular airline, even though the jurisdiction itself was a bit challenging, they were able to do limited amounts for spare parts or smaller amounts for limited amounts. So we were able to help that airline attract capital without Exim Bank support. So we could gracefully bow out and not be needed for certain types of risk, but be needed for the bigger risk. So that, no, it's a very important concept, this idea of crowding in the role that Exim.
Yeah. And Dave, no, if I could just sort of
Yeah,
piggyback and really just want to underscore one of Joe's comments, that this idea of the private market, it's really speaking for AXA, looking favorably on its partnerships with public institutions is very real and very meaningful. I mean, we make no secret about it. A core part of our strategy for the better part of the last decade has been to do just that, to partner with, and we have great relationships with the IFC, with MIGA, with other of your peer export credit agencies around the world. And the reasons for that are, and again, we're very transparent about it, things that Joe mentioned, the leverage of the agencies who have different types of levers to pull than we do as a private institution. It's like the most explicit end of the spectrum, of course, is preferred creditor status we have for the World Bank. But even certainly Exim Bank has real leverage with think about some of your key airline customers who are really dependent upon the bank's financing and are going to make sure to satisfy Exim Bank before others. And also, as Joe alluded to, the other thing is agencies really know their business in particular arenas, and aircraft finance, certainly Exim Bank has a world-class reputation. IFC, again, we have a great relationship with, has boots on the ground in lots of places where we just don't have that kind of insight. And so we are very happy to sort of piggyback on those attributes, and hopefully there's mutually benefiting us participating in really good transactions, and then providing that crowding in of private capital to mitigate risk that goes to to taxpayers.
Mm-hmm. Yeah, no. And speaking staying on this theme of partnering, in Exim Bank's charter renewal in 2015, Exim Bank was directed by Congress to do a pilot program on reinsuring a portion of our portfolio of transactions. And Aon was Exim Bank's broker in developing that program. And Joe, I know obviously you were involved in that, and I was wondering if you could just give us an overview of the pilot program and how it worked and what the reaction of the insurance market was to the pilot program.
Yeah, so it was, I think, hugely successful. Jeff can certainly give you a view from the marketplaces, but very, very successful. And I think it was successful for a few different reasons. One, I think Exim approached it in exactly the right way. You were not new, but a new buyer of protection. And one of the things that you sought to do was establish some important core relationships with key risk takers, and chose the portfolio, the aviation portfolio, because it would be well understood and something that the marketplace could digest. Mm-hmm. And I think you got a good execution on that excess of loss program, good market receptivity, absolutely. I think beyond what, frankly, we had high hopes, and it exceeded the hopes in terms of market receptivity, and worked very well for your entree into the insurance marketplace, reinsurance marketplace. And that's another key point. We use these terms somewhat interchangeably: insurance, reinsurance. You purchased risk transfer, and you had participation from insurance companies and reinsurance companies, and it's a broad marketplace into which to trade. And I think your approach is very successful, and clearly a foundation upon which to build. So even as we've gone through clearly very significant market challenges with the global pandemic and the ensuing economic fallout of that, and we've seen, and Jeff can give you more detailed perspective of this, but we've seen impacts in the global kind of trade credit insurance marketplace. One of the things that has remained very, very true is risk takers have a strong appetite for EXIM and continuing their partnership with you. So I think it was an extremely successful pilot.
Great. Well, thank you for that. Jeff, why don't you, as one of the insurers in the pool for the pilot program, would welcome your perspective on that, what you thought.
Yeah. So we actually ended up being the lead reinsurer with the largest share of the program, and I think Joe really captured it. I mean, so we were really pleased to see the EXIM come to the market. It's almost as if you guys sort of skipped a generation. We do a lot of work and have done a lot of work over the years with lots of other ECAs, mostly on a sort of one-off facultative basis. They have a deal, maybe a tall tree exposure they want to bring to the market. They sort of come transactionally. And I think what was particularly interesting for us and the market, perhaps writ large, was this idea of EXIM Bank coming really at scale with a clearly well-performing portfolio where you had demonstrable expertise in underwriting, that type of asset class. And I think the word is, as I was sort of, considering what really stood out to me, was sort of the transparency. I think the bank was very transparent, provided a lot of data, and really allowed us to I think add some value. I mean, maybe we had a little bit of a leg up in that I had some experience being on the other side of it. But the fact that you had, I think there were nine other
Yep.
insurers who didn't have that luxury that also came to the table. But the amount of data was provided, really allowed us to get quite comfortable independently. One of the things is Joe, you were talking more generally about what sort of attributes of the private market, and one of the things I've learned about is the importance of actuaries and the expertise that we have in insurance companies. We have maybe more than a small army of actuaries, and I never really thought about our business, political risk and credit insurance, as very actuarially driven. But with the data that the bank provided on loss history, let's go back 20 years. We were able to bring in one of our pricing actuaries who did some really, I thought, sort of path-breaking work for us on, can we, validate the expected performance history? Can we sort of get comfort with the pricing? And it was just really a nice marriage for us, and we were really thrilled to be a part of it.
Oh, very interesting. Okay, thank you. Well, you touched on the difference between Jeff, insuring a pool of assets versus a facultative reinsurance. Is there any difference in the analysis that if you of one over the other, or is one easier, or how do you just be interested to hear you elaborate?
Yeah, it's been a really interesting area for us that we have gravitated towards trying to find, and the EXIM deal is the example that we always cite, talking to other ECAs and public sector partners about, look what EXIM Bank did. Isn't this really efficient? It provides diversification of risk, and we really like that model, particularly where, as with your transaction, there was some real skin in the game in terms of risk retention, some real confidence demonstrated by EXIM in terms of their comfort, your comfort with the portfolio, but the need to buy the sort of more catastrophic risk. So there's some other really good programs out there, a couple of which we're very pleased to be a part of, that I would highlight. The IFC has insured their global trade finance program for many, many years, and we have a significant share of that. More recently, the IFC has introduced insurers into their managed co-lending portfolio program, their sort of syndication of their financial institution risk. So we really like those. We have looked at some portfolio deals with private customers, but as you point out, it really is a very different kind of underwriting. We hire lots of very smart people that are good at credit or political risk analysis. Portfolio underwriting, very different. But as I said before, really aligns nicely with a lot of the other sort of core competencies of large insurers in that sort of actuarial space. A lot of really sophisticated modeling tools. So I'd say we've really energized our focus in looking at portfolio opportunities over the last probably 2 to 3 years. And we really hope to continue it. I know we've chatted with you guys about looking at other asset classes, project finance and infrastructure finance. So I think it's very appealing for us and I think for lots of our peers.
I mean, tell me if you agree with this, but I mean, that pool of aircraft transactions that was part of the pilot reinsurance program, many of those borrowers Ex-Im Bank had been working with for years. And repeat customers, Boeing customers buying a couple of aircraft every couple of years, and so there was a long history, and so there was a long history that you could draw on for how they performed during down cycles and prior up cycles, and I think and the fact that it's a standard OECD aircraft sector understanding sort of formula for how to structure them and how to what the maximum repayment terms are and all that. It's sort of standardized it to some extent. Yes, different transactions had different risk mitigants associated with them based on our assessment of the risk, but hopefully that played a role in making the insurance community comfortable with the portfolio.
I think, I don't know, Joe, if others shared their views. I think it was, from our perspective, really essential. I mean, that's really, this was, large aircraft, a space that the private market not unfamiliar with, but the numbers were large. I think it was $1 billion placement. No small thing for us. But again, the proof is in the pudding, and we were able to see the data, which sort of I was well familiar with, but as very clear and transparent ability to show that internally. And I think that performance history really made it I think very straightforward ultimately from our perspective.
Okay.
I think one of the other things, maybe just to add on that, and Jeff, you touched on this, when you have stop loss or an excess of loss program on a portfolio, typically that's designed where you need some frequency of loss to attach to the program. So whereas when you're underwriting an individual risk, if something goes bad on that individual risk, you could be exposed to the loss. That underwriting is really underwriting that that individual entity. Whereas with the portfolio, you take some comfort, as Jeff mentioned, in that portfolio, you need multiple things to go wrong. And so you start to look at the history and how likely is it that multiple things go wrong. The experience that we're all living through is actually very, very helpful, because where anybody starts with respect to analyzing future risk, they often start with the past, what's happened historically. And actuaries, when I started in the business, I always thought it was kind of funny that, you'd have a great loss history. And so you'd say, wow, this is, the marketplace shouldn't charge very much for this risk. And actuaries would say, well, I've got to discount that stellar loss history to some extent, because it's just that they've been lucky and a bad thing hasn't happened, but a bad thing could always happen, right? The insurance industry is always thinking about there is a bad day, a worse day, potentially around the corner. We have to assign some probability of that, however small. Things like the pandemic are actually helpful because it's a massive stress. And you see how institutions respond, you see how portfolios respond, you see how governments respond in those circumstances, and it gives you a data point. And you put that into your view of risk going forward, and it helps you think more holistically about upside and downside. And I think one of the things that's been terrific, and for Ex-Im in particular, is Ex-Im has performed so well through this period. And so I think that will give even further confidence as risk takers look to partner with you in the future on different portfolios.
Now I'd like to talk a little bit about how other government agencies use private insurance to reduce their risks. Joe, I know you've worked with Freddie Mac and Fannie Mae to reduce their exposure to future downturns in the housing industry. Could you talk a little bit sort of about how one underwrites against like a specific one industry risk and how Freddie and Fannie used Aon to and your expertise to reduce their exposure to the housing industry.
Yeah, it's an interesting case, and I think, David, in many ways highlights the benefits that insurance brings, multi-line insurance brings, especially to a monoline entity. And of course, Fannie and Freddie do one thing. They do one thing very well, which is they take residential mortgage credit exposure. And coming off of the crisis, the previous crisis, the financial crisis,
Right.
they obviously were found to have insufficient capital to get through that, and a series of changes took place. One of those changes was to say, at that point in time, they had very limited sources of risk transfer. They used mortgage insurance, which is also a monoline. So the mortgage insurers, many made it through that crisis, but some did not. And so the idea was find other ways, alternatives to that single source of risk transfer. And insurance and reinsurance became one of those in addition to the capital markets. It provides, broadly speaking, two benefits. One is a capital benefit and the other is a risk benefit. Different entities, and there are quasi-government entities, so their capital rules are different from a true government entity like Ex-Im. But if you think about it from their perspective, when they analyze that risk and they look at the spectrum of outcomes, they are entirely concentrated in one asset class. They have no diversification beyond that asset class. So if there is a bad day in the housing market, there are no other markets in which they're having a good day. They have concentration. And this is where the diversification of insurance is very, very helpful, because the insurers who would take that risk candidly would assign lower capital to that tranche of risk than what Fannie and Freddie might assign to that, because the insurers have a diversified source of income streams. And if in fact there is a bad day in the housing market, okay, that's bad, but it's not necessarily a bad day in professional liability or in property risk, for example. And so that diversification means that they have to hold less capital for that risk. That provides a capital benefit. The risk benefit, and this is potentially also a pricing benefit at the end of the day and this is especially some of the conversation we've been having with government agencies, depending on how they price the risk, to the extent that you are alleviating parts of the loss distribution and you are replacing the uncertainty of outcome in that loss distribution with a certainty of premium up front. So you're paying a premium for coverage year in and year out. And we recommend people approach these things programmatically, systematically, in terms of just being part of their business. When you try to time the market on either side, oftentimes that's a fool's errand. You replace the uncertainty of outcome that comes from, just there's a range of potential economic outcomes, to knowing that your losses will go thus high and no higher. And what you're doing in exchange for that is paying a consistent premium over time. You can budget for that. You can plan for that premium. And we've seen it have additional potential benefits in terms of the fees in exchange that you may charge to your customers, depending on how you charge for volatility, and people do it, agencies do it different one to the next. It can actually be also beneficial to the consumers or the commercial enterprises that you're serving. So there's a range of benefits that, in this instance, Fannie and Freddie see, and they're doing a lot of risk transfer. Just one last point.
Sure.
It started with the pilot program, much like your program started with the pilot. There was a single pilot transaction. $77 million of insurance capacity was purchased with a single partner. And now there have been over 50 insurance markets that have taken this risk. The most recent deal we've placed that had over 30 insurance markets. And between the two of them, they're buying between kind of $5 and $7 billion of protection every single year, and it has become programmatic.
Good. I also, Joe, am intrigued by your experience with FEMA and the National Flood Insurance Program. It's sort of deviating a little bit from the export credits and stuff. It would be interesting to hear you talk about, how does one insure against the catastrophic, weather events, natural disasters that are beyond anyone's control and are getting, increasingly severe and frequent as a result of climate change. Just curious how the insurance industry broadly is reacting to that, or what role the reinsurance is going to play to that. I find that just very, very interesting, and something I think we're going to be facing as a society.
Yeah, it's David, it's a very, very interesting time in terms of the evolution of how we're thinking about that risk in the face of climate change, as you mentioned. So FEMA purchased $1 billion of reinsurance protection on its inaugural purchase, and we did not place that transaction, but have subsequent to that worked with FEMA on not only reinsurance but the capital markets transactions. And it just so happened coincidentally that the very first year they bought that policy was the year Hurricane Harvey hit. And they collected $1 billion, paid in about 10 days, I believe, by reinsurers, which I think was good in a couple of respects. It showed that the policies actually pay, because people say, well, insurance companies don't pay, and I had hail damage and it was such a pain to get the insurance company to pay. But insurance companies do pay. I'm sure people have had their individual negative experiences. In this instance, it demonstrated that they paid quickly, 10 days of recovery for taxpayers, which is kind of a great outcome. And then even better, FEMA bought the next year and the year after that. And they've been consistent buyers of the protection. And that's what the risk takers want to see. They want to see consistency in the purchase over time. And that gets, David, to the point of how do you underwrite extreme weather? Because in any given year, you could have any number of events. And what you take comfort in is over time having a view of the frequency of severity. So we have no idea whether or not, we're still in hurricane season here. We have no idea whether there's going to be a massive Cat 5 that goes into, Miami, for example. We've had a storm move up the East Coast recently. We have no idea there could be a massive earthquake at any time. Obviously, we're seeing things like wildfires, the ice storm in Texas. That's just the United States. The reinsurance market in particular is an international market. You have typhoons in Asia Pacific. You have extreme wind events in Europe. So there's no shortage of natural disasters, the flooding we've seen, for example, in Germany. Very hard to predict at any point in time what the weather will be. So what the industry tries to do, and this is similar to what Jeff was commenting on, is have a view of historically over long periods of time what has happened. And that is the foundation of it. But what has developed really over the last 30 years are catastrophe models, natural catastrophe models that use the physical sciences and meteorological data and historical geologic data, for example, for earthquakes, and the best of our statistical methods to add to that history to create, a more robust picture of what could potentially happen with Monte Carlo simulations and broader loss distribution. So those models develop and continue to grow year in and year out as we get more data. We see more things occur, and we're at a point now where we are trying to understand how climate change affects the frequency of severity going forward. So we had a view informed by history of what potential outcomes might be given climate change, how much of that history is no longer relevant, or what's the different lens we need to look through to think about, okay, if sea surface temperatures rise, what does that mean in terms of formation of major hurricanes? Earthquake is a major exposure. That's not driven as much by climate change, but certainly in the West Coast, we're seeing the wildfires. Right. What is that persistence like? And then what are the physical changes that we're making in adaptation around that risk? The one thing, and I'll end on this, that the insurance industry takes comfort from, by and large, the contracts of insurance, and often contracts of reinsurance as well, are relatively short duration contracts. They're typically 12-month contracts. And so one of the benefits that you have in that is that you have ways to reprice the risk over time as you're seeing changes in that exposure profile. Where we see this increasingly, this conversation, and this gets, David, to that nexus of the expertise that the insurance and reinsurance industry has, and how does that add to the overall relationships with government agencies. For example, we've been having a lot of great conversations with Fannie and Freddie, where we started in this conversation, because they have actually much longer dated exposures. In theory, 30-year mortgages. I know the average life is less than that, but and they are, like all financial institutions, trying to think about the exposure changes they have on their underlying business driven by climate change, what that means for different regions that are exposed to extreme weather. And that conversation, because of the expertise and the history that the insurance reinsurance industry has in quantifying this risk and using these models, and candidly understanding the limitations of these models, because we still are in our infancy in developing really clear insights on this that you can put money behind, that has become a much more robust conversation over the last 12 months. And it wouldn't have happened if they didn't have these long-standing relationships from doing risk transfer for the past 6 or 7 years.
Interesting, sort of pooling of expertise from the insurance side as well as the government side. Yeah.
Absolutely.
Yeah. All right. Thank you for that. Very interesting. So we're just returning to the export credit side a little bit, and it's similar to the point we were making earlier about the Ex-Im Bank bringing additional capital to the markets. In recent years, there's been a rise of private sector risk mitigators that have developed to to some extent replace ECA financing with regard to aircraft transactions. There's the Aircraft Finance Insurance Consortium, known as AFIC, and then there's a European counterpart called Balthazar, as well as the Aircraft Finance Solutions Group, which is sponsored by Aviation Capital Group, which also has been supporting both Boeing and Airbus aircraft. I was just wondering, do you think that how do you think that interplays with insurance companies? Do you think that, again, through the experience of seeing what the ECAs have experienced, has made the private sector more comfortable to develop these kinds of programs? And do you see ultimately these kinds of programs perhaps replacing or substituting to some extent for ECA financing, at least with respect to aircraft, large assets?
Yeah, I don't know about substituting for. Hopefully not. I think there's always going to be a role to play for the ECAs, but yeah, for us, we're very familiar with, and are in the case of Balthazar, strong supporter of that program. We are engaged with the folks at AFIC, and iFly is another platform, and in a way, it's kind of almost like we're seeing this same sort of evolution as I was describing earlier, from the sort of one-off, facultative, discrete transactions to more portfolios, and not necessarily that these platforms are bringing portfolio transactions, although there are some sort of warehouse deals that we're looking at that are really interesting and have some of those portfolio characteristics. But they are, as sort of that platform, different origination stream than we typically see, much more focused, bring a lot of their own value add in terms of relationships, in terms of analytics, in terms of legal support. And so I think it has really been, very wise on the part of those folks who developed those platforms, and welcome from our perspective. Again, the idea of having this, this now multiplicity of dedicated channels to a business that we had some very good one-off experience with over the years. The private market has been there ensuring bank financiers of not only aircraft, but other mobile assets like shipping finance. I think very similar, although we haven't seen those same kind of platforms. Maybe it's a business opportunity for someone out there to do the AFIC of shipping. But yeah, I think they're very welcome additions. And we are sort of agnostic, I suppose, in terms of sources of origination. But again, we see a lot of efficiency and a lot of value add that they bring. But to your point about the role of ECAs, maybe I'm not well positioned to comment on that. But I just think, look, the counter-cyclical nature of Ex-Im and the Airbus ECAs in particular, we've seen that come to the fore in the past. we've seen during the sort of challenging times for XM from a authorization perspective, we did see these, AFIC, I think in particular, was a direct response to that. So I don't know, in a way, the market is kind of working as designed. And so I think there are those continual roles are going to be played by these various entities. And hopefully that, continues to provide a variety of options for, the manufacturers and for the airlines. And, it's sort of makes the pie larger for everyone, I suppose.
Yeah, in a way, it's spreading the risk among a bigger pool of people.
More players, yeah.
Yeah, exactly. The more the merrier. So other than the ways of working together that we've already discussed, can either of you think of any other ways that Ex-Im Bank can work with the private insurance market to diversify our risk or to achieve our objectives of supporting exports? Any other thoughts on how we could work together?
I don't know, Joe, you may have broader views on this, but just a quick comment for me. It's just that we have seen and participated in lots of different structures. We have reinsured ECAs, like your XM deal. We have fronted and been reinsured by ECAs and other public agencies. We've worked, programmatically on, quota share bases. So, everyone sharing the same risk from the ground up. We've had great success with and are very attracted to, maybe for obvious reasons, providing excess, catastrophic type cover, a la the aircraft portfolio. We've also done that more broadly, Joe, while you were talking about the sort of broader insurance market and weather risk and other things. I thought of a deal that we did with maybe a non-traditional space for credit insurance, but we've worked with a lender in the farm credit system, covering a livestock portfolio that, as kind of a one-off deal, we would never have touched just based on risk profile and our expertise. But the way this was structured on a portfolio basis, where we were providing this excess cover, very comfortable with, would love to replicate with other members of the farm credit system. So I just think there's lots of different ways that you can get at it. I've gone around and talked to, when we could travel, I made a trip to Scandinavia a couple of years ago and talked to the ECAs there. Smaller ECAs, maybe different motivations than Ex-Im Bank in looking to the private market to take out these really extreme exposures that they have based on the sort of limited nature of their economies. So lots of different ways to skin the cat. And I think there's, we can't do everything. We have our own risk appetite at AXA, but there are, I don't know, Joe, 60 private credit insurance markets out there. You can find somebody to do almost anything. So I think there's lots of optionality.
Yeah, I think I certainly echo all of Jeff's comments. And one of the things I think that, and Jeff was such a great example of this, is what you find at many of the insurers, and certainly at AXA XL, is that breadth of experience, right? And so you can sit down with Jeff and get that full perspective and talk about motivations that you point out, the objectives of what the client wants to achieve, and then go in almost any direction in designing something that works. That's the flexibility of the insurance coverage. I think you have the nature of that product is different from a capital markets execution, and it's really a bespoke cover that's written in a contract and has a lot of flexibility. But on top of that, you have the individuals, great, leaders in their space like Jeff, who really understand the business with fluency. And therefore, you can partner with them in a very creative way to find what works. And in addition to all the structural options that Jeff outlined, there's all kinds of different ways to do it. One of the things that I just think is a really interesting area for all of us is we've seen such a sea change, in my estimation, around commitments across ESG, right? And just in the past year, we've seen massive change in those commitments. And that has become a fundamental objective for many institutions, both public and private. I think there are incredible partnership opportunities as Ex-Im looks forward and wants to engage in certain objectives around its, E&S components of ESG in the portfolio to partner with risk takers in ways that are great for both sides, because risk takers are certainly looking for ways to be more proactive in developing solutions that are, have social impact and obviously an positive impact for the environment. So that's an area that I think could be of particular interest.
Very good, very interesting, very good points. Well, thank you very much. I'd like to very much thank our panelists, Joe Monahan and Jeff Abramson, for their sharing their expertise and their time with us today. That concludes our discussion, our formal discussion. I would now like to open up the floor for questions from the audience. Thank you very much.